Hey everyone, welcome back to iSpy Academy. We're now entering week 6 of the program, and this is where things start to get even more interesting and more practical as we shift from analyzing the market to analyzing the businesses inside it. Up to this point, we've explored broad market forces, financial instruments, sectors, and cycles. But now we zoom in. This week, we're diving into corporate finance essentials, the financial engine behind every company you'll ever trade or invest in. Because here's the truth, behind every stock chart is a business, and behind that business is a financial strategy. Understanding how companies raise money, manage resources, and return value to shareholders gives you a real edge. It helps you see what's driving price action before it shows up on your charts. You don't need to be an accountant. You don't need to memorize formulas. But you do need to understand how businesses make financial decisions and how those decisions shape earnings, risk, and stock performance. That's what we're going to unpack today. And it'll lay the foundation for next week's session on valuation, where we'll start answering the big question, how much is this company actually worth? So let's jump in. All right, here's where we're headed today. By the end of this session, you'll be able to describe the core goals of corporate finance, what companies are actually trying to achieve when they make financial decisions. Read and interpret the purpose of each major financial statement without needing to be an accounting expert. Understand how those financial decisions, things like raising capital, managing debt, or returning profits, directly connect to a company's stock price and valuation. Distinguish between funding strategies like debt versus equity and why the trade-offs between them matter. And finally, you'll be better prepared to jump into valuation fundamentals next week, where we'll use everything from today to help determine what a company is truly worth. So with that roadmap in mind, let's dive into the heart of it, starting with the question, what is corporate finance? So with that roadmap in mind, let's dive into the heart of it, starting with the question, what is corporate finance? So what exactly is corporate finance and why should you care about it as a trader or investor? At its core, corporate finance is the decision-making framework companies use to manage money. It's about how they raise capital, how they spend it, and how they deliver returns to owners, which in the case of a public company includes you if you hold the stock. Let's break it down with 3 core questions every business has to answer, whether it's a Fortune 500 firm or a startup building out of a garage. Number 1, investment decisions. Where should we put our money to grow? Should we build a new factory, acquire a competitor, launch a new product line? These decisions shape the company's future earnings, and if they're wrong, they destroy value. If they're right, they compound growth, increase market share, and make the stock more attractive. Second, financing decisions. How do we raise that money? Companies typically have 2 options: equity, selling shares and giving up partial ownership, or debt, borrowing money they'll have to repay with interest. Debt is often cheaper but comes with fixed obligations. Equity is safer but dilutes existing shareholders. The trade-off here directly impacts risk, flexibility, and even valuation, especially in volatile markets. Third, return or dividend decisions. What do we do with the profits we've earned? Reinvest back into the business, pay dividends to shareholders, buy back stock to reduce supply and boost EPS. Each choice reflects a different business model and tells you what kind of company you're dealing with. Growth companies usually reinvest everything. Mature companies may prioritize dividends. Tech giants like Apple often lean into massive buybacks. And for us as investors, these signals help us assess whether a company is building long-term value or just coasting. Big picture takeaway, corporate finance gives you a lens to understand what's happening behind the chart. You stop looking at a stock as just a ticker and start seeing the real business decisions driving its movement. When you understand how a company allocates capital, you gain the ability to anticipate strength, spot weaknesses, and identify hidden opportunities before they show up in price action. And that's exactly the kind of edge we're after here at Fundamental Edge, and why iSpy Academy exists. Now that we know what corporate finance is, let's talk about where those financial decisions show up, the financial statements. Every public company is required to share these documents, and they give us insight into how the business is performing. But here's the key: you don't need to become an accountant. You just need to know what each statement tells you and what to look for. There are three core financial statements, and each answers a specific question about the business. The first being income statements. Is the company profitable? This is often called the profit and loss statement, and it's basically the company's financial scoreboard. It shows how much money the company brought in, what it spent, and what it kept as profit over a period, usually a quarter or a year. Key line items you'll see: revenue considered top line refers to total sales. Expenses, costs like materials, salaries, R&D. Operating income, what's left after core business costs. Net income bottom line, what's left after taxes and interest. This is the number Wall Street watches during earnings season. If a company beats expectations, the stock often jumps. If it misses, it drops, even if the long-term fundamentals are strong. Second, we have balance sheets. What does the company own and what does it owe? Think of the balance sheet as a snapshot. It tells you what the company looks like at one moment in time. It includes assets, what the company owns: cash, equipment, inventory. Liabilities, what it owes: loans, bills, leases. And equity, the net worth of the business, assets minus liabilities. Here's the equation: assets equals liabilities plus equity. If a company has strong assets and low liabilities, that's a good sign. If it's drowning in debt or has more liabilities than assets, that's a red flag. And when interest rates rise, the risk from debt grows even more. Third, we have the cash flow statement. Is the company actually generating cash? This one often gets overlooked, but it's incredibly important. A company can look profitable on paper, but still be losing cash behind the scenes. It's broken into three parts: operating cash flow, cash from day-to-day business; investing cash flow, buying or selling assets; financing cash flow, issuing stock, taking on debt, or paying dividends. If a company consistently generates strong operating cash flow, it usually has the flexibility to survive downturns, reinvest in growth, or return value to shareholders. Let's put it all together. Each statement gives you one piece of the puzzle. The income statement shows performance, the balance sheet shows strength, the cash flow statement shows resilience. When you analyze them together, you can start spotting undervalued companies, risky balance sheets, or signs of disciplined management. And this combined financial understanding is exactly what we'll build on next when we talk about how companies structure their finances. So now that we've looked at what companies earn and what they own, the next question is, how did they fund all of it? This brings us to capital structure, which is just a fancy way of asking how much of this company is funded by debt and how much by equity. Let's start with equity financing. Equity means ownership. When a company sells shares through an IPO or by issuing new stock, they're raising money by giving away a slice of the business. The pros? There's no repayment required and it doesn't increase the company's debt. But the cons? It dilutes existing shareholders and sometimes it can signal that management believes the stock is overvalued. Now, debt financing. Debt means borrowing money from banks by issuing bonds or taking out loans. The company keeps ownership but now owes interest and has fixed repayment obligations. The benefits are clear, no dilution. Interest is often tax deductible. And in bull markets, debt can help boost returns through leverage. But on the downside, debt increases risk during economic downturns, and if overused, can put serious pressure on a company's cash flow and creditworthiness. There's no perfect mix. It really depends on the company, the industry, and the market environment. Tech companies tend to favor equity for flexibility. Utilities and industrial firms often lean toward debt because they have predictable cash flows to support repayments. As an investor, a company's capital structure gives you insight into its risk level, especially in times of economic stress or rising interest rates. There are also a few key metrics to be aware of here. The debt to equity ratio tells you how leveraged the company is. The interest coverage ratio shows whether the company can meet its debt obligations, and WACC, or weighted average cost of capital, reflects the blended cost of financing through both debt and equity. We'll build on that concept next week when we start digging into valuation. Bottom line, capital structure is strategy. It tells you how a company thinks about growth, risk, and control. And if you understand how a business funds itself, you understand one of the biggest drivers behind how its stock performs, especially in changing macro environments. Now that we've talked about how companies raise money, let's shift the focus to something even more important, how they use it. This is where great companies truly set themselves apart, not just in how much capital they can generate, but in how wisely they allocate it. Because remember, capital is limited. Every dollar a company earns is a decision point, and what they do with that dollar tells us a lot about their priorities, their leadership, and ultimately their value to shareholders. This is what we call capital allocation, and it's one of the most underrated concepts in all of finance. Let's break down where capital typically goes. Reinvestment in operations includes expanding factories, upgrading tech, launching new products, hiring top talent. This is the engine of organic growth. Companies in their high growth phase, think Amazon in its earlier years, often plow everything back into the business. Mergers and acquisitions, buying other companies to gain market share, acquire talent, or enter new sectors. This can be a fast track to scale, but it's also risky. History is full of overpriced acquisitions that destroyed shareholder value. A good allocator knows when an acquisition adds value and when it's just ego. Paying down debt, reducing financial risk, and improving flexibility. In rising rate environments, this becomes a smart strategic move. Freeing up cash flow from interest payments can dramatically improve long-term performance. Dividends, distributing profits directly to shareholders. This is typical of more mature companies that generate consistent profits but may not have high return reinvestment opportunities. Think Coca-Cola or Procter & Gamble. Stock buybacks, repurchasing shares from the market to reduce share count. This boosts earnings per share and can support the stock price, but it only adds value if shares are repurchased at a reasonable valuation. Some companies use buybacks to hide slowing growth. Others, like Apple, use them with strategic discipline. So, how do we as investors know whether these capital decisions are good ones? We look at return on capital. Let's break down three key metrics. Return on equity, ROE, net income divided by shareholder equity. It tells us how efficiently the company is using investor money. A high row can signal strong management or excessive leverage, so context matters. Return on assets, ROA, net income divided by total assets. This measures how productive the company is with everything it owns. It's especially useful when comparing asset-heavy industries like manufacturing versus asset-light companies like software. Lastly, we have return on invested capital, or ROIC. This is the big one. It measures how much return the company generates on all invested capital, both debt and equity. It cuts through the noise and shows you for every dollar invested into the business, how much is coming back. A good ROIC, say 15% or higher, suggests that the company has a strong competitive position and is making high quality decisions with its capital. And here's the kicker. Studies show that companies with consistently high ROIC outperform the broader market over time. Why? Because their internal reinvestment machine compounds wealth more efficiently, year after year. This is why Warren Buffett always says, the key to investing is determining the competitive advantage of any given company, and above all, the durability of that advantage. Capital allocation is where that advantage shows up. Now, let's get tactical. If you're analyzing a stock, ask, is the company reinvesting in high ROI areas or chasing growth for the sake of growth? Are buybacks reducing share count or just offsetting stock-based compensation? Are acquisitions aligned with core strengths or spreading the company thin? Is debt being reduced, rolled over, or ignored? These questions reveal a company's true financial mindset. A disciplined allocator doesn't always go for what's popular. They go for what compounds. And great investors look for management teams who treat capital like it belongs to someone else, because it does. In short, capital allocation tells us who's playing checkers and who's playing chess. Companies that consistently make smart allocation choices, even in uncertain times, don't just survive, they compound. And that's the kind of business you want to own. Now that we've explored what makes up a smart capital allocation strategy, let's look at a real-world example that ties it all together. Apple. This isn't about the iPhone or branding, it's about how Apple handles money and why investors trust it so deeply. Let's start with the basics. In 2023, Apple reported about $383 billion in revenue and over $97 billion in net income. That's a net profit margin of nearly 25%, which is incredible for a hardware-based business. Most manufacturers have razor-thin margins. Apple, on the other hand, runs its business like a luxury brand. High pricing power, loyal customers, and tight cost control. Now look at its balance sheet. It holds around $27 billion in cash and equivalents, which gives it major financial flexibility. At the same time, Apple also carries over $100 billion in debt. So why would one of the most cash-rich companies on earth borrow money? It's strategic. Apple took on debt because at the time, interest rates were historically low, and borrowing was cheaper than repatriating foreign cash due to tax laws. This allowed them to fund share buybacks and dividends without disrupting their core operations. And they've done so in a way that keeps interest payments completely manageable. Their interest coverage ratio is extremely strong. That leads us to capital allocation, where Apple really shines. Let's talk buybacks. In the last decade, Apple has spent over $500 billion repurchasing its own shares. That's not just financial engineering. It's a calculated move that reduces share count, boosts earnings per share, and supports long-term shareholder value without overextending themselves. They also pay a steady dividend, not huge but reliable, signaling stability. And unlike many big tech firms, Apple doesn't chase massive acquisitions. You won't see them overpaying for flashy companies just to make headlines. Instead, they make targeted, strategic purchases, often acquiring small firms to bolster specific technologies like chip design or privacy software. And what about R&D? Apple invests over $27 billion annually, but always within its cash flow, not in a way that sacrifices discipline. It's a commitment to innovation, but with boundaries. Now let's connect it to return on capital. Apple's ROE sits above 150%, partly due to buybacks reducing the equity base. More impressively, their ROIC hovers around 40%, far above market averages. That means for every dollar Apple invests, whether from debt or equity, it's generating 40 cents in return. That's elite. But here's the most important part. It's not just about the numbers, it's the mindset. Apple's leadership, particularly under Tim Cook, treats capital like a limited resource. Every financial move is deliberate, methodical, and aligned with long-term value creation. Now, let's contrast that with a company on the other end of the spectrum, like AT&T. AT&T pursued a very different approach over the past decade. Instead of disciplined capital allocation, they made a series of massive acquisitions like DirecTV and Time Warner, spending tens of billions in search of growth. Many of those deals were poorly timed, over-leveraged, and ultimately reversed. They took on heavy debt loads, issued more shares, and even had to cut their dividend. The result? Lost investor trust, stagnating share price, and poor returns on capital. So, what's the lesson? Capital allocation is not about how much money you make. It's about what you do with it. Apple and AT&T both had access to capital, but Apple allocated it strategically while AT&T chased scale without discipline, and the market rewarded or punished them accordingly. When you analyze a stock, don't stop at the income statement. Go deeper. Are they funding growth responsibly? Are buybacks actually reducing share count? Are dividends sustainable? Is management focused on long-term value or short-term flash? If the answers reflect discipline and strategic thinking, you may be looking at a high-quality business worth holding long-term, not just trading. That's why Apple isn't just a tech stock. It's a case study in world-class corporate finance. And next week, we'll take all of this a step further and start learning how to value companies like Apple using financial tools and models. Let's wrap up today's session with something more reflective, something that takes us beyond numbers and ratios, because at the end of the day, great traders can spot price action. But great investors, they understand why the price moves, and that almost always traces back to what's happening inside the company. This is where we step into the shoes of a CFO. A chief financial officer doesn't just manage budgets. They make strategic decisions under pressure about growth, risk, timing, and capital allocation. In many ways, they think just like a trader or long-term investor, constantly weighing risk versus reward, opportunity cost, and financial timing. Let me give you some real examples of the CFO mindset in action. Let's say a CFO chooses to delay a major product launch, not because the product isn't ready, but because they want to preserve cash flow during a down quarter. or they issue long-term debt at historically low interest rates, locking in cheap capital for future expansion. Or they initiate a buyback program after the stock drops 20%, signaling internal confidence and improving investor sentiment. None of these moves show up in the chart immediately, but they set the tone for what will happen later in earnings surprises, valuation re-rates, or breakout trends. And this is exactly why capital allocation strategy often precedes price action. The market eventually catches up, but the smart money sees it first. This week's recommended reading, The Outsiders by William Thorndike, is all about this idea. It profiles 8 CEOs who radically outperformed the market by mastering one thing: capital allocation. Not charisma, not hype, just discipline. They focused on maximizing return on invested capital, buying back stock at the right time, avoiding unproductive acquisitions, using debt intelligently and sparingly. One of the key takeaways from the book is this: the most successful CEOs were capital allocators first and operators second. That flips the usual narrative. These weren't flashy visionaries, they were stewards of capital, quietly compounding shareholder value by consistently making smart long-term decisions. And that's the kind of leadership you should be looking for as an investor. So here's your mindset challenge. Think about the company you analyzed in this week's assignment. Is the leadership acting like disciplined allocators or just managers? Are their financial choices aligned with long-term value or just short-term headlines? Because if you can learn to think like a CFO, to assess decisions based on risk, return, and capital impact, you'll start to anticipate market movement instead of reacting to it. And that's how you go from informed to strategic. Next week, we'll pick up right here and learn how to translate everything we've discussed today into actual valuation methods. But before we close out, let's look at this week's assignment to help you practice what we've covered. Choose one publicly traded company, preferably one that you're interested in or already tracking. This could be a stock in your watch list, one you've traded recently, or just a company you're curious about. Then answer the following prompts. What's their debt to equity mix? Is it aggressive, conservative, or somewhere in between? How has it changed over time? Are they consistently generating free cash flow? Are profits growing, flat, or declining? Is there a difference between their reported net income and their actual cash flow? What are they doing with their profits? Are they reinvesting into operations? Are they paying dividends or buying back stock? Any recent acquisitions, and were they strategic? Based on everything above, would you invest in this company long term? Do you trust their financial discipline? Is their leadership acting like a smart allocator of capital? Your second task is more philosophical, but just as powerful. Read Chapter 1 from The Outsiders by William Thorndike, or a summary video if you're short on time, and answer the following. Is your chosen company acting like the kind of disciplined allocator described in the book? Would the CEOs featured in The Outsiders admire this company's approach to capital, or would they raise red flags? Pick one financial decision from your company, a buyback, a dividend, an acquisition, a debt raise, and explain what it reveals about their leadership mindset. Submit this as a journal entry, discussion post, or part of your case analysis video. This week's assignment is a bridge between theory and practice and a prep tool for next week's deep dive on valuation, because when you understand how a company handles capital, you're already halfway to knowing what it's worth. And that wraps up week 6 of iSpy Academy Corporate Finance Essentials. Today we covered a lot, but at the core of it all is one idea. Great companies don't just make money. they manage it well. We unpacked how companies raise capital through debt and equity, how they structure that funding to balance risk and growth, and how they allocate resources to create long-term value. You now know how to read the financial statements that matter most: income, balance sheet, and cash flow, and how to interpret them like an investor. You understand why capital allocation isn't just an internal decision, it's a market signal. A signal that shows whether leadership is thinking ahead, managing risk, and building something worth owning. You've seen what smart allocation looks like through Apple and what poor allocation looks like through companies that chase scale without strategy. You've also taken the first step toward valuation, because knowing what a company does with its money is essential for knowing what that company is worth. Next week, we'll build on everything we've learned and tackle valuation fundamentals, how to measure intrinsic value, evaluate pricing multiples, and spot undervalued opportunities in the real market. In the meantime, take your time with the assignment. Reflect deeply, pull up real financial statements, dig into company behavior, and start asking not just what is this stock doing, but why is it moving this way? As always, if you have any questions, submit them using the QR code on the screen. And don't forget, if this content is helping you build clarity and confidence in your trading or investing, like, comment, and subscribe. You can find links to our Discord group, recommended tools, and all course materials in the video description below. Thanks again for being part of Fundamental Edge and iSpy Academy. I'll see you next week.